There's a way to borrow money at near treasury rates, cheaper than your mortgage, cheaper than any line of credit, and most financial advisors have never heard of it. If you have $1 million portfolio and you need short-term cash, a bridge loan for a house, a tax bill, a renovation, your advisor probably suggests one of two things: a margin loan or a securities-backed line of credit called an S-block. Both are collateralized by your portfolio. Both sound reasonable. And both are terrible deals. Schwab's current S-block rates range from 5% to 8%. Their margin loan rates run from 10% to nearly 12%. You're borrowing against your own assets and paying rates that would embarrass a car dealership. Meanwhile, there's a strategy used by institutional traders called a box spread. It uses 4 options contracts on the S&P index, all with the same expiration date, structured so that no matter what the market does, the outcome is identical. You receive cash up front. You pay back a fixed amount when the options expire. The market risk cancels out completely. It's a synthetic loan, and the effective interest rate is just slightly above the Treasury bill rate, currently around 4%. Compare that to 10% on a margin loan. Here's why the rate is so low. Traditional lenders set rates based on overhead, regulatory costs, profit margins, and default risk. A box spread bypasses all of that. It goes through the options market, where pricing is driven by the time value of money, essentially the risk-free rate. The Options Clearing Corporation guarantees every trade, so counterparty risk is near zero. You're borrowing at the rate the market charges for time itself. The Options Clearing Corporation guarantees every trade, so counterparty risk is near zero. You're borrowing at the rate the market charges for time itself. And the tax treatment makes it even better. Because a box spread produces a net loss on options contracts, the interest is deductible as a capital loss. Most box spreads use S&P 500 index options, which qualify under Section 1256 of the tax code, meaning you can deduct part of the interest every year the spread is open, even before you actually pay it back. So you're getting a lower rate than an S-block, and the interest is tax deductible when S-block interest is not. The catch is operational complexity. Until recently, you had to manually construct 4 separate options trades. Most advisors don't touch options. But new platforms like SyntheticFi and Vest are now handling the execution, making box spreads accessible to any advisor with clients who have taxable portfolios. The real risk is margin. The loan counts against your brokerage account's margin requirements. If you borrow 50% of your portfolio value and the market drops 29%, you get a margin call. The solution is simple: borrow conservatively. At 25% of portfolio value, you'd need a 64% market crash to trigger a call. Here's what this teaches us about how money actually works. The best financial tools aren't hidden because they're dangerous. They're hidden because nobody profits from telling you about them. Your bank makes money on margin loans. Your brokerage makes money on S-blocks. Nobody has an incentive to show you the option that costs less and gives you a tax break. The edge in finance has never been access to secret information. It's having a system that finds the optimal structure for every dollar, and an advisor who's incentivized to show it to you.